Hi, everyone. Thank you for joining our July market update presentation. Many of you have heard me say over the last few weeks that the markets have been a lot like that romantic comedy movie that we have all seen before. We always know how the ending is going to end. The guy and the girl always end up together. But unfortunately, right now we are at the climax of the movie where one of them is messed up and we're questioning what's going to happen. And we're especially questioning how long is this movie going to last. So don't want to make light of losses in the stock market and of your hard-earned money, but I do want to talk about what history tells us about stock market declines and what you may expect going forward. My name is Valerie Leonard, founder of EverThrive Financial Group, and we're also going to talk today about the R word, recession. We're going to talk about what this really means, where we may be headed, and how long you might expect the ride or the movie to last. So one note before we get started, we're always here to answer questions that our clients may have when they come up, but we also want to keep people informed through our YouTube channel. So with monthly market updates, timely market reaction videos, all these things, if you want to subscribe to our EverThrive YouTube channel, you will be notified every time we post a video, and you'll always be up to date on the latest information that we put out. So just click the subscribe button down on the right-hand bottom of your screen. So let's start by talking about what's really going on with the economy, and are we in a recession or will we be in one soon? You've probably heard this term a lot in the news. So let's first talk about the official definition of what a recession is. So we take this definition from the National Bureau of Economic Research, and they define a recession as a significant decline in economic activity that is spread out across the economy and it lasts more than a few months. So based on this definition, are we in a recession? Not officially, but the signs are getting stronger and we could see an official recession announcement later this year or into 2023. So one thing to note about a recession is that they aren't officially called a recession until after we've seen several quarters of slowing growth. So you as an investor are going to personally feel the impacts of a recession before it's made official. Right now, you feel the effects of inflation at the grocery store, at the gas station. You feel the effects of a recession with concerns about your spending or your investment account. So although there are still positive economic signs right now, investors feel like they're on a topsy-turvy ride. I know we all do at the moment. So this is one reason that we watch consumer sentiment so closely. This is a really important factor. And consumer sentiment and the expectations that consumers have about the future can have a direct impact on the depth or the duration, the length of a recession. Consumer sentiment in June has been holding steady up until that point, but it dropped in June to a historic low. And market underperformance in the second quarter was driven by concerns that we have all had as investors. So take a look at this chart here and the difference between the orange and the blue lines. The orange lines represent expectations that consumers have, and the blue line is our present economic situation. So what you'll see in this chart is that the economy is actually much better than consumer expectations about the future are at the moment. Now, recessions are also typically accompanied by heavy job loss, but there's been an average of 475,000 jobs added each month in this calendar year so far, and unemployment was at 3.6% in May. We've also seen business spending remain strong, so these are all very good signs, but still the economy is starting to lose momentum, and consumers are noticing this trend. So two important things that you need to know about this past quarter. First of all, economic growth slowed because we finally saw businesses holding surplus inventories. Okay, what does that mean? I think it's really, really interesting. We've all heard about supply chain constraints, and retailers over the last couple of years have been over-ordering products because of these supply chain shortages. But now Walmart and Target, for example, announced that they're overstocked, and this is dragging down economic activity. The second thing that you need to know is that the Fed is fighting inflation with interest rate hikes. That's probably no surprise to you, but they're becoming even more aggressive in their approach. This chart here shows that the Fed's efforts to get inflation down below 3% in 2023 and back to 2% or so in 2024, this is kind of the trajectory. But we're feeling the consequences of their efforts to get ahead of inflation right now. So as of Friday, July 15th's market close, investors were actually starting to expect the Fed to lower interest rates after the first of the year. So we're kind of seeing mixed signals right now, but it's almost like the Fed is trying to rip the Band-Aid quickly off so that the pain will be bad for a short period of time. And if they're successful, our economy might stand a chance at getting back on track even sooner. But the real question is whether their actions are working and is inflation starting to slow? So the answer is not just yet, but we may be seeing inflation peaking. Last week, headline inflation was reported to be 9.1%, and food, housing, and transportation were the biggest contributors to this figure. So these are the categories that I want you to watch when you're listening to the news: food, housing, and transportation. So because we saw such big increases in prices in these areas, this is going to force the Fed to raise rates aggressively at the end of July. I'm actually expecting a 1% rate hike in the Fed funds rate when the Fed meets on July 26th and 27th, simply because they can't pivot their stance just yet. But we're actually seeing accelerating inflation in the entire world, 32 out of 35 economies globally. So the United States isn't the only country that's been forced to raise rates in the middle of a slowdown. Thankfully, though, the United States, our dollar here is strong, and it's getting stronger relative to other countries throughout the world. The other thing to look at is wages. So you'll see here, as reported in the Wall Street Journal, that wages are up 4.2% since this time last year. But because of the inflation effect, wages are actually down over 4%, 4.4% to be exact, since last year. So we have less purchasing power as Americans. Also, let's talk about earnings season that are ramping up. We continue to expect profits to be down this quarter, with many companies likely suspending their stock buybacks. They're indicating concerns about slowing growth. I suspect that this is going to be a bumpy quarter both here in the United States and throughout the world as companies announce their negative earnings growth. So this is to be expected. I've talked about this a lot with many of our clients. When you think about how earnings are being compared to this time last year things were good. So while the headlines that announce the slowing growth may sound scary, you need to remember that we're still growing as an economy. We are still expanding even with slowing growth. So things may not be as bad as the media would lead you to believe. And then also bond investors, we've been watching their actions closely, and we've noticed, especially last week, that they're concerned about the coming year, and they weren't buying shorter term bonds like 2-year bonds this past week, but they were buying 10-year bonds instead. Now, I've said this before, you may have heard me mention this, but if you watch the bond market, it will help you understand the stock market much better. So we need to see bond investors get more confident in the short term for the stock market to start to recover. Now, the good news is that we've started to see some bond yields normalize over the past few weeks, which may be a sign that the bond market is normalizing. It's still too early to tell, but this is a good sign. What else are we watching? So the housing market is an important driver of the economy, of course. Everybody wants to know what's going to happen with housing and with the value of my home. A lot of people are still in the market for a home. Right now, lack of supply, rising prices, and rising mortgage rates are headwinds to housing sales. So it's like the wind is blowing straight at you, makes it harder to buy a home right now. And it continues to be a challenging time for investors because of rate hikes and the pressure that this puts on the stock market also. So again, I point back to consumer sentiment. Watch that, and it should give us some signs on the depth and the duration of the pain. Now, despite these headwinds that I mentioned in housing, there's still a reason for optimism. It's interesting to pay attention to demographics within the United States and the role that population trends may play in helping to boost our economy. So as you'll see here in this chart, the average age of a first-time home buyer in the United States is 32 to 33 years old. And this age group right now represents the largest age group in the country. Now, if you look at the age group behind this one, so ages 25 to 34, that is also healthy from a population standpoint, which means that housing demand should remain really strong for the next few years, and that may help the United States economy. So if you compare these trends to, say, Europe or China, for instance, you'll note that their demographic trends are actually headed in the opposite direction. They have smaller numbers of people in those age groups that will be buying homes in the coming few years. So that may mean continued weakness there for years to come in their case. Now, last month, we reminded everybody that the best way to ride a roller coaster is to exit safely, and that the worst days in the market are typically within the weeks of the best days in the market. So I want you to remember that if you exit the market during a dip, you can lose out on a market recovery very easily. And at EverThrive, we always try to keep a plan in place for better than expected outcomes in the market and also worse than expected outcomes. And we're always here to help you with every up and down that you may experience. So this doesn't mean that you shouldn't expect to lose money when markets are down. It just means that we're preparing as best we can to help you navigate the bumpy ride. And before we wrap up, I want to remind you of what stock market history has taught us about how long stock market declines like we're seeing right now might last. Now, this isn't a prediction for the future, but it does tell us a lot about probabilities going forward. And I've shown this slide before because it is really important for you to understand. As of Friday, July 15th, close of business, the S&P 500 was negative by roughly 19.8% from its peak in early January. So keep in mind that it was down in June by about 24.5% or so, and it has made a slight recovery since then. So right now it's down 19.8%. But if we look at this chart, what you'll find is there have been 86 cases throughout history going back to 1945 where the stock market was down between 5 and 10%. And the average time that it took the market to recover was only 1.5 months. There were also 28 cases where the S&P 500 was down between 10 and 20%. And in these 28 cases, the average time to recovery was 4 months, but it also took 4 months for the market to fully decline. So this would be more representative of where we are right now. There were 9 times where the market was down between 20 and 40%, with the average time to recovery being 13.8 months. And in those cases, the market declined for about 10.6 months. And then, of course, there were 3 cases where the market was down more than 40%, with the average time to recovery being 58 months. So there have been some scary times out there. And but we do want to keep in mind that 90% of the time, roughly, markets recover fairly quickly when you think about your entire investment lifetime and how long you will hopefully have money in the market. Also, here is where each sector has performed since the beginning of this year. This is as of Thursday, July 14th. And it's a good reminder that it's important to remain diversified, because while everything is negative in this case, if you're looking at that far right-hand column that shows each sector and where it stands year to date, while everything is negative, some things aren't as bad as others. So take consumer staples and utilities, for instance. These sectors have held up much better than, say, consumer discretionary or technology. So risk management is important, and while it can't fully protect you against losses, it can help you avoid major pitfalls. If you would like your investment portfolio evaluated from a risk perspective to determine whether it matches your attitude about the future or the current market environment, or the level of risk that you're comfortable with and the returns that you hope to achieve, just shoot us a quick email to info@everthrivefinancial.com. We will ask you to take a quick assessment to determine what we call your investment speed limit, and we will compare it to your investments to see if they match up. So your investment speed limit in our case can be from 0 to 99. And what it does is it helps us figure out how fast you want to go as an investor, how slow you want to go, and hopefully helps us set guardrails on either side of the road so you don't drive off of a cliff. So once we know your investment speed limit From there, we can advise you on whether you're positioned appropriately and if changes should be considered. So that's it for this month. Thank you so much for joining us, and we will see you again in August. But until then, please do your best to ignore the short-term volatility and try to focus on having a long-term perspective as an investor.